Hello, everyone. Today's lesson for Reinsurance 101 is going to be based off of unearned premium and earned premium. These are two terms that we hear about in every single reinsurance session statement review. However, not everybody actually understands what those terms are, and that's what today's lesson is all about. So we're going to have a couple of assumptions here. So we're going to assume that the premiums we're going to do in this example, in this exercise, is going to be $1,000 worth of premiums. So that obviously would come from the sale of a service contract. And we also have an assumption that the service contract term is 5 years. So this is how it works. When you write a service contract or you write any policy that is reinsured, those premiums, when you write that contract and you pay for the contract, those premiums are going to go into your unearned premium bucket. And in this scenario, we're going to refer to those as your UE. So these premiums earn out over the course of the contract. So the contract in this example is 5 years. Keep in mind, most administration companies, they move the monies around, and some of them use different formats. So I'm not going to get into the whole formatting. Reverse rules of 78 is the most common. So what happens is over the course of the 5 years, these unearned premiums are going to they're going to earn out, and they're going to move from your UE bucket over to your earned premium bucket. At the end of the 5 years is when they would be fully earned. There's a term that you may also hear that we often discuss in a session statement review, and what that is what your earned percentage is. Earned percentage, okay? So again, these $1,000 first go into your unearned bucket over the course of 5 years. Depending on the administration company structure, these monies are going to move over to your earned bucket. When they're in your earned bucket, that is where your loss ratio calculation comes from. So that is going to be based off of how many of your premiums are earned based off of how many claims that have been paid. The number that we always want to shoot for an industry standard is we always want your loss ratios to be under 65%. And again, that's going to come from your earned bucket. Now, what this also means is when these monies do move over to your earned bucket, those monies there are available for you, Mr. Dealer, to borrow up against or take a distribution. We always recommend you always borrow against those monies, because if you take a distribution, that's where you're going to pay capital gains tax. If you take a loan against yourself, you're not going to have to pay those capital gains tax. So I hope this enlightens a few people that are paying attention today on this lesson. I hope it makes sense. In the event that you would like to learn more, or if you'd like to go into a further discussion, and if you would like us to review your session statements, which we do complimentary at no charge to you, feel free to give myself a call or anybody on the IFS team, and we'll be happy to help you out the best we can. Thanks so much.